Hey everyone, Andrew here. So having a steady stream of dividends flowing to you each month could be a great way to retire early. Like I get that. And if that is your goal, well, you will want to know about Dividend Aristocrats. A Dividend Aristocrat is a title given to a company that has increased its dividend each year for 25 years in a row. That is a pretty incredible considering the things that have happened over the past 25 years. We've had the tech boom and the bust, and then the global financial crisis, and then a pandemic. That is a pretty good stress test of a dividend. So if a company has made this list, it is truly special. But companies can drop off this list quickly with poor management changes, so don't invest in these blindly. You still need to do some work on them. Anyway, let's go through the list of the 2022 Dividend Aristocrats. So I have a link to this list in the description underneath the links for Interactive Brokers, which is the best broker on the market, and it's the broker that I use, and a link to my e-magazine with my updated watch list, which I publish each month. So I think this table actually gives us enough information here. We've got the years of dividend growth. So for 3M, 64 years of dividend growth. That's amazing. And the dividend yield as of about early February is 3.7%. It's quite a good dividend yield. Let's have a look at some of the other good dividend yield companies here. We've got AbbVie at 4.5%. That's pretty high. Armcor at 4.2. The list goes on and on here. You can scroll through this whenever you feel like it yourself. What I wanted to sort of look at is there's Coca-Cola, there's Colgate-Palmolive, so there's a lot of companies here that we're very familiar with. I thought I would go to Procter & Gamble and have a little bit, go through that in a little bit more detail, just to show you why Dividend Aristocrats maybe sometimes underperform the market. Okay, so I'm looking at Procter & Gamble here in TIKR Terminal, and if I look at just the price chart, I can see that over the past, well, I can go back, I think we've got 15 years here. 15 years, the share price appreciation has been about 6.1% per annum. Now, if I look at how the company has actually been performing over that period of time, I want to look at the revenue growth. So we've got in 2005, it looks like 56 billion. So I'm going to work out 56 billion. I'm going to work out the average annual growth rate, like the compounded annual growth rate of revenue. So now it's at 78, and now at today's prices we're at 78.3, and that has been over 15 years. And we calculate that, and it tells us it's been about 2.2% per annum revenue growth. So the reason we've been able to get 6% return from the share price appreciation, well, it's because there's a 2.5% dividend, which we've seen, that's why it's on the Dividend Aristocrats list. Plus there's been about 1% per annum of share buybacks. I can look at that by going in the income statement. So I look at the weighted average diluted shares outstanding, and I look at it says 3,200 back in 2006, and now it's down at 2,600. So that has been decreasing over time. It's about 1.5% or so. So that plus the 2.5% dividend, plus the revenue growth at about 2.2%, that gives us around about 6% per annum. And the share price has kept in line with that just about perfectly. So for 15 years now, we've had about 6% per annum in the price appreciation of the stock. Plus you've had about a 2.5% dividend as well throughout that time. So your return from this investment over the 15 years has actually been about 8.5%. But because we just saw the revenues only growing at about 2% over that period of time, plus the share buybacks, the company is actually growing on a per share basis at like 3, maybe 4%, somewhere in that range. Yet the money that we've been able to get from the appreciation of the share price plus that dividend is far higher than the actual underlying business itself. So if that's happening, generally that can't sustain itself because the multiple must be expanding over time as well. Therefore, generally speaking, we're only going to get what the business does over the longer term. So we're probably only going to get that 3 or 4% plus the dividend. So all of this means that you've actually been able to get about 8.5% per annum on this investment over 16 years. Now that's nothing to complain about. But I think that share price appreciation could easily slow as the company is growing at only 2% revenue growth. There's 1% buybacks. So that's only 3% moving forward in share price appreciation. I think that's probably fair. You do get that dividend on top. So what, 5.5%. Probably not going to get you very far, but it is safe and it is better than losing money. Now here on the screen are the 4 criteria to become and remain a dividend aristocrat. So you have to be a member of the S&P 500. Well, what about the Australian and England companies or smaller companies that are outside the S&P 500? So anyway, it rules all them out. You have to have an increased per share based dividend every year for at least 25 consecutive years. Well, my question is, are these companies doing this because they make so much money, or were there times where they actually had to borrow money to issue their dividend just to keep up this reputation? I'd have to go into each company to find out. The third point is they have to have a minimum market capitalization of at least $3 billion. I don't know why that's important, but anyway, this is how the list was created. And the fourth thing is they have to average at least $5 million in daily share trading value for the preceding 3 months. And I haven't worked out why this is important at all. As you might be picking up, I have questions about this entire exercise, and I don't know whether dividend aristocrats are even good investments. Reliability. Fans of dividend investing appreciate a reliable source of income. Now, these companies tend to also be the leaders in their industries, with reliable cash flow and a track record of impressive annual returns. And dividend aristocrats are less volatile than the broader market. Now, all that being said, in recent history, dividend aristocrats have underperformed the S&P 500 in total returns. I guess the advantage is a company that pays out an ever-increasing dividend is ideal for investors looking for stable income. Remember, however, that a dividend is a portion of the company's profits that it is paying to its shareholders in the form of cash. Any money that is paid out in a dividend, well, that's not getting reinvested in the business. So if a business is paying shareholders too high a percentage of its profits, it may be a sign that management prefers not to reinvest in the company given a lack of growth opportunities. And therefore, a dividend aristocrat may be messing up the growth opportunities or not have any growth opportunities to redirect those profits. Also, company management can use dividends to just calm down frustrated investors when the stock isn't going up. Now, that said, if a dividend aristocrat is able to grow the payout it gives to the shareholders on a regular basis, like they've proven, I guess it does imply some organic level of growth in order to fund these payments. They wouldn't be able to keep it up for 25 years otherwise. So it provides a stable income for shareholders, and it is a positive signal indicating strong financials. But we also have that dividends may be paid instead of growth opportunities, and dividend stocks often produce poorer capital gains, as we saw in that graph, and dividend payments are taxable events. And there's something I haven't touched on yet, but because the dividends are taxable, it would normally be better to keep that money inside the business, let them compound it in growth initiatives over time, and eventually they will pay that money out in a lot bigger amount of money because it's compounding tax-free. But if they give it to you, you have to pay tax. Anyway, so that is the basics of dividend aristocrats. I hope that was helpful. Maybe dividend investing is your style and that's what you like. Look, it's not my style, but there are a lot of things that aren't my style. I personally think that if I wanted income from my investments, I would aim for companies that I think can compound at really strong rates for a long time. And if I need a bit of money for living, I can just sell a few shares from time to time. I mean, if the business can grow at, say, 15% per annum and I take maybe 1% per annum, then I'd prefer that 14% per annum over, say, 6% like Procter & Gamble. Anyway, I hope that was helpful for those thinking about a dividend portfolio strategy. So it's a big shout out today for Gris Farr for your questions and comments. Always great to hear from you. You are a legend. Thanks for staying to the end of the video, and I will see you next time.